Yeah, hello everybody, welcome back. This is now business taxation again, and we are talking about trade tax. This is part 3 of the trade tax lecture, and we are here now, the determination of the trade tax profit. Well, we will not be able to talk about all of this at the moment, but at least the first half will be done today. Well, a first important remark concerns the terminology, so the use of the technical terms. The trade tax base is orientated or based upon the income from business. But nevertheless, it's not identical with that figure which comes out under income tax for income for business. That result is modified again in certain ways. For that reason, the income from business under income or corporation tax is not automatically identical with what we would call the trade tax base. And in order to make that clear, the German law reflects that by choosing a slightly different term or terminology or denomination for trade tax purposes. And so in our translation of the German laws, and when we talk in English about the German laws, we should reflect this different terminology by just choosing also a different denomination for the trade tax base. My personal suggestion is just to call it trade profit. There we have the reminder trade, which alludes to trade tax. Instead of profit from business, income from business, or the like, all terms which we have already used for income tax related terms. In German, the German word for trade profit would be Gewerbeertrag, and the German word for the income tax term would be Gewinn aus Gewerbebetrieb. And well, that is just for those who later want to talk with German conversation partners too, because then you must be able, if your conversation partners use different translations, to avoid confusion and to clarify or state clearly what you mean by your English translation. So then it's always good that you can have the original German words. Okay, that said before, we come now to the next logical step. You have just heard that the trade profit is not completely identical with the income from business. And so the question is naturally, why is there a difference? Now, that can be easily understood because imagine, ladies and gentlemen, that your idea is you want to tax the income from business. Now, only the income from business. And then the question is, which consequences would that have? Yeah, why? Sorry, here evidently I forgot to type something. So, why do you modify this? And the answer is, let me have here a complete list of many different modifications. Why do we have all the modifications? The answer is, yeah. Now, what can be the answer? The first thing which sometimes explains modifications is tax saving ideas. And so the first simple modification that is in our list here, some slides ago, add backs of certain expenses. Why does this exist as a difference? Well, easy tax saving models. Imagine, ladies and gentlemen, you have an enterprise 1 and an enterprise 2. Both have an overall profit of 500,000 euro, which they can generate. So they are equal. So they would also pay the same trade tax. Now, some business owners also are clever. So what will we find out? The owner of Enterprise 1 has an idea. What about running my own enterprise with money which is not my own? So I get a credit from the bank, I pay interest to the bank. That's interest expense. My profit goes down to 400,000. Now, the money which I own is money which I can then place in the bank. So the bank pays me interest, but the interest is interest income, and that will be taxed separately. It is not subject to trade tax. Okay. So as you see here, probably the difference between the interest which I have to pay on all my capital, which I borrow from the bank, and the interest which I get for the money which I placed into the bank account is only a small difference. And perhaps if I save the trade tax on the 100,000, that could perhaps be a higher tax saving effect than the difference of, let's assume, 2,000 or 3,000 euro between the interest I pay and the interest I get. So that would be a good deal. So it's expectable that everybody does it, or at least that enterprise owner 1 does it. Profit goes down to 400,000. He or she saves the tax, the trade tax on the additional 100,000 because the trade profit has been lowered. Now, enterprise 2, finance with equity, sees what the neighbor has done, begins to think, I finance my business with my own capital. Am I mad? So enterprise owner 2 will copy the whole idea, and so we will have a drop down of the tax base here too. Okay. Now, after that, probably the tax rates go up, and now enterprise owner 1 again is clever and has an idea. What can I do in order to lower my trade profit? Well, let's talk about premises, buildings. Up to now, I used my own buildings. Now I sell them to my wife or my spouse or to whomever, and later pay a rent to be able to use them. In that case, the rent is a business expense. And in the hands of my spouse or whoever owns these things now, that's lease and rent income, and no trade tax is due. So just by shifting that money into the hands of somebody else, into another type of income, we have freed that money from the trade tax burden. Now, if you have no spouse or don't trust your spouse because a divorce is going to happen soon or so, then you might say, okay, then we must do it another way. For example, you might knock on the door of enterprise owner 2 and say, hey, 2 guy, until now, I own my factory building, you own yours. What about this? You sell me your factory building, I sell you my factory building, and then we pay lease payments across. By the way, you could not do it this in the plain and simple and open way, because that would be regarded as a kind of a tax abuse. But to follow a general strategy, my own money is always invested into buildings and houses which have nothing to do with my own firm. And my firm is in rented premises. Well, that could be a clever strategy. Everybody does it. And when you ask them, well, if I have an own building, I'm nearly nailed to the floor. I have to stay there for the next 20, 30, 40 years. I'm absolutely inflexible. I can't change the location. So that is why I prefer to rent the building. Well, and that I invest into immovable property, well, that's always a good capital investment. And if the profit situation of my firm goes down a bit, or if I want to retire, then I need a current income from a stable investment like a house or several houses. So that's perfectly reasonable. And everybody does it. So enterprise owner 2 will copy the whole strategy, and again the money vanishes. Now you have a drop down in the trade tax base again. The city trade tax rates will probably have to be increased to compensate for the loss. What happens next? Well, you can not only rent buildings, you can also decide not to buy your own machines, but husband, wife, cousin, or a friend buys machines and lets them to you for rent, and you pay rent. And so more and more expense lowers the trade tax base, and in the end, only idiots and those who cannot get rid of their profits pay trade tax anymore. So you program the drop down and the elimination of the tax. So if you just take over the income tax result, that's a kind of stable and safe route to self-destruction of the tax base here. The tax base would completely dry out. So everybody would shift the money which the firm generates just into the hands of other people, where that money is no longer labeled as income for business. If you want to counterattack that now, then you must put the trade tax base computation on a different basis. You must say, okay, it must not matter to whom the money in the end is handed over. If it has its origin in the productivity of the firm, it should be and remain a part of the trade tax base. So every money which is generated in the firm shall be taxed by trade tax, irrespective of the owner keeps it or hands it over to somebody else later. So all these nice interest and rent payments and so on, which we mentioned, that is money which had its origin in the firm. It was generated there. The only thing is, it was handed over to somebody else. Now, the conclusion should be everything which has its origin in the firm should be taxed. So the interest which the owner paid to the bank, that money had its origin in the firm. It was produced or generated there. The only difference to the owner's profit is that money was handed over to somebody who gave capital to the firm, namely to the bank, but it is money which comes from the firm. So it should be covered by trade tax. And so if it had been booked as interest expense, so that interest expense posting should be reversed, eliminated for trade tax purposes. So a deduction for interest expense should be added back, and that is where the name add back comes from. It should be added back to the profit for the purpose of trade tax, so that the interest is also taxed, although it is handed over to somebody else. The rent payments which the owner makes to the owner of the buildings, the money has its origin in the firm. It was then just paid over to somebody else, namely the owner of the house. So if it has been deducted for income tax purposes as a business expense, it should be included back into the trade tax base. So add back the deducted expense, eliminate the expense deduction. That money should be taxed under trade tax, although it leaves the firm and ends up in the hands of the house owner. So similar payments should be treated in a similar way. That's the basic principle here. And what you must understand is that is absolutely vital and necessary, such an add-back mechanism, because otherwise you can erode, decrease the tax base according to your own taste and wishes, because there would be no end where it stops. You can always generate expenses which you pay over to others, and so you could always shift that money from the taxable sphere, the business, to the hands of some other people who are not subjected to trade tax payments. And that is why the expense deduction is blocked then for trade tax purposes. Now, for legal certainty reasons, you cannot just say everything which is suspicious of being subject of a trade tax saving trick will be added back. You must make a clear list of all the expenses which the law wants to add back to the trade profit. And so what can you do here? You need to set up a list. That list can be found in paragraph 8. That's add backs to the trade tax base. And the list is there in number 1, letters A to F. So it's 6 positions. However, once people decided to put up that list, everything that on that list has to be added back to the profit, so has to be taxed with trade tax. Then politicians began to mingle with the stuff and to mitigate the effects a bit, because they said, well, business owners could probably show a strong opposition against us if we put up a tax where we tax money which the owner doesn't keep. Well, in principle, that's not really surprising. Very often that happens. For example, the owner of a business has to withhold wage tax from your wage and give that to the fiscal office. From all the turnover, they have to keep back value-added tax and give it over to the fiscal office. So very often you have similar effects. The problem seems to be that in that case here, you have to remind the business owner that if he or she takes up credit, they should also calculate not only the interest rate, but also that the trade tax on the interest comes on top. Or if you conclude a lease contract, that not only the lease has to be paid, but the trade tax on the lease payments comes on top, and so on. If you know that in advance, the market forces could probably bring along a proper outcome also. At least you would know as a business owner, if I sign, let's say, a contract which obliges me to pay 6,000 euro lease payments, that is economically equivalent, let's say, to 8,000, including trade tax on top. So that would not really be impossible if business owners were educated enough and would care for the consequences. Yeah. But now politicians, as I said, feared that a bit and wanted to mitigate the tax burden for the business owners. And so they watered down the basic idea a bit by the following measures. First, they said, well, from all the total of the add backs, you can deduct on the add backs under this number. You can deduct a free allowance of 200,000. So they could say to all the owners of small businesses, yes, it's probably a very unfair, brutal rule. Huh? You know, politicians never understand what they are talking about, especially when they are talking about taxes. So they would probably say, yes, it's a horrible rule, yes, yes, but it doesn't affect you if you do not pay more of 200,000 of these expenses. So all the small business owners look around and say, okay, I have a small newspaper shop. I do not pay more than 200,000 to banks and to building owners, so not my problem. And surprisingly, if something is not somebody's individual problem, that person's engagement for justice directly drops down dead. So all these people cease to be in opposition to that rule. And now, for the ones who are left over, there is then a psychological problem. Imagine 10 people storm into a room, highly outraged and crying around, and somebody says, well, this only affects those of you who pay more than 200,000. Then you see the knives are taken down, the hammers are put down silently. People say, okay, now you are the 1 out of 10 whom it still affects. Now you do not want to disclose to all the others that you are so rich that even your interest payments and rent and lease payments to others exceed an amount of, let's say, 200,000, or that you pay even 1 million to others. So you probably calm down a bit and get cautious. That's the first political effect of such a free allowance. And then you try to comfort them who are left over. Okay, compromise. Only 1/4 of the remaining amount is really put under the add-back rules. So 3/4 are left tax-free. Then you begin to grumble around a bit and say, okay, that's nearly not material anymore. So what you see here is that the original compelling concept has been watered down considerably, although there is a compelling reason behind it. And so we have a kind of a political compromise. You add everything up under letters A to F. Second, you deduct 200,000 as a free allowance, and third, you divide by 4. So that's exactly the calculation scheme. And here something is very, very important, because in the text of the law that quarter is mentioned first. Now that confuses people, that the last step of the calculation is first mentioned in the legal text. So people then try, when they solve cases, to change the calculation step sequence and to begin with directly taking 1/4 of every position which is mentioned in the case. Now that's the straight road to hell, because 1/3 of x minus 200,000 is completely 1/4 of every summand. Then minus 200,000 is completely different from x minus 200,000 and the rest times 1/4. And for this reason, you must strictly stick to the prescribed sequence of the steps. How can you really fix that or hammer that into your memories? Well, the first thing is look back a bit. First step begins with add, like A in the alphabet. So A for add everything. That's the first step, with an A in the alphabet. The second step, deduct 200,000. The 200,000 begins with a 2, like second step. And now, just to make it more difficult, the third step is then dividing by 4, not by 3. Here, one might think about a petition to our politicians. Would it be better to divide by 3? But as dividing by 4 leaves over a smaller amount, nobody complains. And so that is a kind of a first way how you can memorize that. And there is even another bit brutal way to memorize that. You are not allowed to take the 1/4 first. In the Middle Ages, ladies and gentlemen, people were often treated not nicely. Very often you were condemned to death. Naturally, everyone only once, usually, at least successfully. But the trick was, as everybody was easily killed for slightest offenses, people developed then a tendency to make things more cruel. So there were really cruel ways to kill you: hanging, drawing, quartering, drowning, whatever human fantasy can generate. And very often, several of these execution methods was even combined if you did something which was especially horrible. For example, high treason, that is betraying the king or so. For that, you got really cruel punishments combined. So a favorable English punishment for high treason was drawing, hanging, then they cut you off, and then you were quartered. So cut into 4 pieces, or drawn apart into 4 pieces by horses or so. I don't know the details, and I don't want to know them. And if you want to sleep calmly, then you shouldn't be interested in that. But you can believe me one thing: quartering the victim was only the last step of an execution. Yeah? To divide somebody into 4 parts usually ended the fun for the executioners. So you could always be sure quartering was only at the end. Huh? And this is, again, what you will probably never forget. The trade tax is a tax from the Middle Ages, sorry. And so even when you compute the add-backs on the trade tax, same principle. Quartering, so divide into 4 parts or take a fourth, is only at the last step, because otherwise the delinquent is dead in the first moment and then the fun is over. So just to show you the sequence again, let me roll back here. Add everything with an A at the beginning. Then second step, 200,000 with a 2 for second step. And third step, divide not by 3 but by 4. And never begin with dividing by 4, because quartering always comes at the end of the procedure. Good. When we know that now, let's have a look to the wording of the law, which says in paragraph 8, to the profit from business, the following amounts are added back if and as far they have been deducted during the computation. A quarter of. Now you see, the law mentioned this first, but you know and will never forget, quartering comes only at the end. Remunerations for debts, pensions, and recurring financial burdens, shares in the profit attributed to a silent partner, 1/5 of the lease and rent expense for the use of fixed assets which are movable assets and owned by someone else, 1/2 of the lease and rent expense are for the use of fixed assets which are immovable property, 1/4 of the expense for release of rights, blah blah, and so on, as far as they surpass a free allowance of 200,000. So you see here the second step is mentioned at the end. So whoever wrote this passage of the law was really an expert in confusing people. Good. Now allow me some last remarks on the different positions. Interest is everything which you pay for debts, and so the law even describes it in a neutral way as every remuneration for debts. If it's expense, naturally payback of a credit, the payback amount is not an expense. You get rid of a liability, so it's neutral. That is not added back, but only the interest expense. Interest must be interest, so if something is just masked as interest, but in reality a hidden profit distribution, you can't add it back as interest. The same applies to interest payments, which a partnership makes to a partner for a credit which the partner gave to the partnership, because you have learned in the partnership taxation part of this lecture that German law does not acknowledge interest payments between a partnership and a partner. So what does not exist for tax law cannot trigger an add-back. Pension payments. All payments which are paid out as a pension, but not pensions paid to employees of the firm, because wages are deductible expenses and pensions paid to an employee of the firm are nothing else than a wage payment which has been deferred in time and which is paid out, let's say, 30 years after the employee rendered his or her services. But which pensions can then be left over? Mostly pensions which were paid for the acquisition of a good, an asset, or a complete firm in exchange for a lifelong pension for the seller. Sometimes that exists, especially when a seller has no children, or if the children are the buyers, then very often the seller says, okay, I'm not interested in the capital, I'm just interested in having enough money to spend during the rest of my lifetime. Let's agree to a pension-based sale. So an adequate purchase price for my property is just transformed into a monthly pension payment which is extended over my expected rest of life. Such a pension payment then usually consists of an amount which is considered as a part of payback of the underlying obligation of the underlying purchase price, which is by the pension payment paid back in installments, and an interest on the still outstanding, unpaid or not yet paid back part of the price. Only that part of the pension which can be regarded and booked as expense is covered by the add-back rule. So if A buys a business from B for a lifelong pension, and the monthly pension payment shall be 5,000, that would be 60,000 per year, but also you would have in the balance sheet at, let's say, the beginning of the year, the obligation for the lifelong pension valued, let's say, with 800,000. And at the end of the year, you have to evaluate the present value of the outstanding pension payments again. Let's say it dropped down to 780,000. So you had a certain revenue or gain from the drop down of the value of the obligation. So you have two postings. The first is pension expense of 60,000 against bank. And the second one is pension liability drops down by 20,000. So of the 60,000, 20,000 were not really pension expense, but the gain from the decrease of the pension obligation. So 20,000 of the underlying obligation have evidently been paid off. So only the 40,000 would be held back. Profit shares of a silent partner, that can only apply to a so-called typical silent partner, because an atypical silent partner would be considered as a co-entrepreneur, and payments made through a co-entrepreneur would not be a business expense. Only payments to a typical silent partner can be or could have been booked as an expense, because only the silent partner, which is typical silent partner, is an outsider from the firm from the perspective of German tax law. So only to him or her payments are made which can be classified as a kind of interest payment to a credit. So they would be added back, although they are not strictly interest and it's not strictly a debt, but it would be treated in the same way, and so it should be treated in the same way for trade tax too. If you have forgotten the difference between a silent partner who is a typical silent partner and an atypical silent partner, repeat part 2 of this lecture. That is the lecture on partnership taxation. Well, and you should know, naturally, a silent partner is nothing. It's not a limited partner of a KG. It's something completely different. Okay. 1/5 of the lease and rent payment made for movable assets, which otherwise would be fixed assets of the firm. Letter D, that is only 1/5, because if you had bought the assets for yourself, then you would also have costs. And if you say, I don't buy the assets, but somebody else does, and that somebody else gets a rent payment from me, then you not only lower your income by the expense, but you also save costs. So you lower the profit only by the difference, by the profit span of the person from whom you rent the machines or what else it is. And that profit span is here assumed to be 1/5 of the payment in case, because you can't determine it in the individual case. The customer does not know what the owner charges as a profit span, so the law just say, let's assume it's 20%. Lease payments for fixed assets can only exist if the lease contract is still regarded as a lease contract by law, and not if it's regarded as a covered purchase contract. If the lease contract is by tax law regarded as covered purchase contract, and if the lessee I believe the guy who leases the stuff, who takes it. So if your farm is regarded as the economic owner, and if the thing is qualified for tax purposes as a purchase contract with paying out the price in installments, then there can be no lease and rent payments for trade tax. So in case where leasing contracts trigger economic ownership of the customer, this cannot be applied here, because what you own is nothing what you can lease anymore. And lease payments from partnership to a partner naturally do no longer exist. As you know, that would be just giving the partner in question an additional profit share and would not have been booked and acknowledged as expense, for tax purposes at least. In case of house lease and rent contracts, the profit span is assumed to be higher, here 1/2, 50%. The reasons why not 100% is added back are the same as before. Fixed assets in that case are all the assets which would not be current assets. So if you had bought them, they would have been fixed assets. That is the idea. So even a house which you rented for only 3 days would be covered by that rule, because if you just rent a house for 3 days and you do not intend to sell the house, it would not be current property if you bought it, bought fixed property. And so you should not look to the time, but look to the character of the asset which has been bought. The same problematic interpretation is also applied to the previous letter with the movable. And naturally, the previous remarks on that economic ownership exclude leasing, and that lease payments from partnerships to partners are impossible, apply here too. Good. Lease and rent. Forget about this. Now you have another thing: 1/4 of all payments for the permission to use rights for a limited amount of time. That means license payments. Why for a limited amount of time? Well, if you pay for a right to use it for an unlimited period of time, then you have bought that right, and the purchase price, that is not a problem here. There would be just depreciations and so on, then you can't pay lease amounts or license fees for that right. So only a license fee, a current payment per year or so, is meant here. And only 1/4 is added back, because 1/4 is deemed to be the profit span here. By the way, what's really problematic is here is 1/4 taken into account. Then later, when everything is added up, second step minus 200,000, and then third step again 1/4. So this 1/4 here is not the 1/4 which you have at the end of the computation. Excluded from that add-back rule are certain payments for which the firm has already to pay the German so-called Künstlersozialabgabe, that's the social security contributions for artists. That is something which somebody has to pay. For example, if you give an order to a designer or another artist to do something for your firm, then you have in principle to pay what would usually be the employer's part of the social security contributions if that artist were employed. And the reason why this is not included in the add-back rules is that in such a case, the license payment or the payment to the artist is already so expensive due to these additional costs that nobody would ever use it for a tax-saving attempt. So yeah, and now after that overview, the last thing which we have to do is to practice these things with example cases. And this is not going to happen in this video. That is to be undertaken in the next video. Until that next video comes, I wish you a good time. Recover well from listening to today's lecture. Enjoy the time and come back to the channel soon whenever you like it or whenever you have the feeling you should do it. Thanks for watching and see you back soon next time. Thanks.